story of how Western automakers are inviting the Chinese to take their US, Canadian, and Western European market share. Unless you've been living under a rock for the last 2 years, you already know that the price of everything has gone through the roof, and cars have been no exception. The price of used vehicles has shot up about 35% over 2019, and new vehicle prices have jumped about 20%. Specifically, the average price of a new vehicle in the United States is $47,000. Okay, if you take out the luxury brands, it gets it down to $43,000. Still big money. Some auto industry pundits say that prices will return to normal in a year or so when the supply chain balances itself back out. We believe this is absolutely wrong, and that the Chinese are going to fill the void. And here's why. In the years leading up to 2020, it became normal for the auto industry to have about 65 days worth of inventory. But huge consumer demand combined with component shortages have transformed auto inventories down to a meager 32 days. That imbalance between supply and demand has done two things. It's allowed major auto manufacturers to queue up hundreds of thousands of orders for new vehicles. The most notable example of this is the Tesla Cybertruck, which currently has 1.2 million back orders. Ford stopped taking deposits for their F-150 Lightning after quadrupling the original allotment and sold out all 200,000. Kia had so many pre-orders for its awesome EV6 SUV that they also stopped taking deposits. The second thing it's done is provide historic, record-breaking profits to both dealerships and manufacturers like Mercedes, Toyota, BMW, GM, Ford, and on and on and on. A recent report in Bloomberg calculated that Ford was the hardest hit of all the major OEMs, resulting in them being short by more than 1 million vehicles last year. But they still made almost $18 billion in profit. To put that in context, the year before, Ford had lost $1.3 billion. General Motors broke its previous all-time record and made $10 billion in net income, which was up 55% from 2020. When supply chains do level out and manufacturers can produce as much product as there is demand, the two factors we just explained are going to come together to keep prices high and dealership inventories low. Manufacturers have learned an awful lot of consumers are willing to wait for special order vehicles. And it's anticipated that the traditional Western auto manufacturers will never go back to 65 days of inventory, but instead settle out somewhere about 50% more than they are now, near the 45-day range. And that'll probably happen in the next 18 months. Much like oil and gas investors have demanded companies return billions of dollars of unexpected profits to shareholders while they still can, auto manufacturer investors are absolutely going to insist that Ford, GM, Mercedes, Volkswagen, and all the other usual suspects pay them out after years of mediocre returns. Western auto builders are going to focus on just two things in the next decade. One, returning profits through dividends and share buybacks to their investors. Secondly, they're going to continue substantial investment in electric vehicles, because even short-term investors know that the consumer demand for EVs is going to skyrocket as governments bring new regulation to both encourage electric vehicle purchases and to heavily dissuade internal combustion engine production. This will leave little money for Western auto manufacturers to invest in developing lower margin, mid and entry-level electric vehicles. Ford, VW, Mercedes, GM, and the other big automakers are going to be busy working on the mid to high-end range to maximize their profitability. So at this point, you might be asking, what does this have to do with the Chinese? Well, a good question. This shortage of reasonably priced automobiles in Western markets like the United Kingdom, Germany, France, Canada, the United States, Australia, and on and on and on, leaves a gigantic hole in the market at a time when the Chinese auto manufacturers are more than just considering opening Western dealerships. The amazing electric vehicle auto manufacturer named NIO, which is headed by a very Elon Musk serial entrepreneur named William Li, opened dealerships in Norway last year and is opening more dealerships in Germany this year, 2022. And in case you're thinking nobody could be as good as Elon Musk and Tesla, well, think again. NIO has arguably a superior product to Tesla in many ways. Number one, NIO's self-driving tech is apparently better than Tesla's. Number two, NIO has a broader range of vehicles, not just the 4 that Tesla has, which are really just 2 that they actually sell in volume, the 3 and the Y. Number 3, all NIOs have the ability to swap batteries. This means NIO has more configuration choices than Tesla does, and anybody else for that matter. They can profitably sell their $50,000 Tesla Model 3 equivalent for about $35,000 and make up the difference with monthly or consumption-based subscriptions to the battery. Keep in mind that you don't have to swap a battery with the NIO. You can still plug it in like a Tesla or any other electric vehicle, but if you want to, you can swap it out faster than most people can fill up their gas vehicle. Number 4. We think that the NIO product actually looks better than Tesla's. And keep in mind, we've owned 2 Teslas. The NIO design is simply more appealing to our eye. Then there's a company called VinFast, which you probably haven't heard of. And to be clear, they're not actually Chinese, they're Vietnamese. VinFast is opening dealerships in Canada and the United States right now. They made a big splash at the LA Auto Show, and their product looks great, and it is going to sell. If you think you'd never buy a Chinese vehicle because you remember low-quality products of yesteryear, well, again, you should think again. Did you know that the Cadillac CT6 plug-in hybrid and the Buick Envision are exclusively manufactured in China, but sold all over the world, including North America? Then there are dozens of Chinese electric vehicle makers, like these Chinese juggernauts, BYD, Xpeng, and Geely, just to name a few. Let's go through those very quickly. Geely owns some brands you might have heard of: Volvo, Polestar, Smart, which used to be Mercedes Smart, and Lotus, among half a dozen additional brands. BYD sold a massive 600,000 electric vehicles in 2021, and it is financed by America's highest profile long-term value investor, Warren Buffett. Xpeng sold 53,000 of their X7 SUVs last year. And you think 50,000 doesn't sound that much. Well, for a comparison, Ford sold 55,000 Mach-E's last year, which is about the same number of regular Mustangs they sold. And those are considered correctly to be giant successes by both consumers and stock market investors. All of these companies have publicly stated that they will expand into Western Europe, Canada, and the United States. Low inventories, high prices, and Western companies focusing on their high-end brands to keep profits high just invite the Chinese in. The Chinese could not have timed this better for an invasion of the lucrative North American and Western European auto market. Western automakers like Ford, Mercedes, Volkswagen will continue to ignore the mid-market as they focus on those higher-end, higher-profit electric vehicles. By 2025 or 2026, we expect at least 3 substantive Chinese auto manufacturers to be selling their high-demand, high-quality electric vehicles in a showroom near you.